the goal that you're trying to get to. Would you agree? And that's for me, I think.
Location fits into it. So the long and the short of it is.
Absolutely. How about at the end of the day, do you do anything? Like, I'm really fascinated by rituals and things like that.
So I think it's really important to be ethical and make sure you're paying them well above.
Innovators is that, when you look at it.
Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Good afternoon, good evening, good morning, g'day, wherever you're from, and wherever you're watching, whether you're on ASA YouTube, Rask YouTube, Twitter, LinkedIn, Facebook, have I got them all? Selfwealth, of course. Rob's in the chat. G'day, everyone. G'day, Colin, and everyone that joined a little bit earlier. We do have a poll running in the Rask YouTube channel, which does say, are you worried about managing your finances for your retirement? And 53% say yes, but only a little bit worried, which is great. That's good news. That's positive. I take that as positive, considering I'm probably not that way inclined. So well done to you if you are not too worried. But g'day, Salah, Hassan, everyone. Welcome to today's session. We've got a very special one. We've got Andrew Deremuth, or sorry, should I say Dr. Andrew Deremuth, otherwise known as Drew Meredith in the real life. So we've got financial advisor, financial planner, retirement specialist Drew Meredith on the show with us today, answering retirement questions. We're going to talk about passive income. We're going to talk about building an investment portfolio and hopefully get your questions answered. Before we go on, there is a link in the video. So if you are on YouTube, there is a link there. There's a few actually. There's one for financial planning where you can get in contact and get matched with a financial planner. There's another one there to join Selfwealth if you're new to the Selfwealth community. And there are a few others like for show notes and the weekly emails that we get sent, that we send out. So we've got a few slides to share today before we get to Drew. You can join the Value Investor Program. This was up last week. A few people have already taken it on board. Full investor training. It's now $200 off. You just use that coupon code DEALS200 on the Rask website. Just Google Value Investor Program. So we go live every Wednesday, sometimes during the day, sometimes during the evening. In the next couple of weeks, we're going to be going live during the day for a few reasons, because we've got some fantastic guests with us. So Michael, you just said poor video quality, Owen. Let me just check my video quality. Okay, it says that I'm streaming at 1080, but it could just be my internet connection momentarily, Michael. So hopefully it improves, or at least I can turn off my ugly mug and you can just look at the slides. Have you subscribed yet? Whether you're on Selfwealth, Rask, ASA, do us a favor and subscribe. I think we're almost at 20,000 subscribers on Rask's YouTube channel. Selfwealth over 11,000, ASA like pulling up the back, but it's getting there. It's getting there slowly. So please make our day. Subscribe. You get notifications whenever we go live. Good morning, Megan and Deepak. You say you love the day sessions. Yes, it does make life easy for many of us, but some of us, like those in WA, it does make it a bit more tricky. So here's my joke for the week. My gag from Dad Says Jokes on Twitter. My sister just delivered a baby. I knew she had it in her. That is my joke. So that is it for the week. How did I do out of 10? G'day, everyone that is joining from having their lunch or something like this at work, and you're making the effort to show up today. It's fantastic. It is a special day when we can talk about retirement. I know it's the number one topic in the Rask community, and I imagine much the same for Selfwealth and ASA, of course. So Rob, you're saying the video quality is fine for you. G'day, Rodney. Good to see you in the chat. So 8 says Hassan out of 10. That's not bad. If you've got 3 minutes, maybe a couple less, a couple more. If you've got 3 minutes, I'm just going to paste a link in the chat for a research form that we started last week. Some of you have already filled in the form for the Rask Live. Basically, what we're doing here is we're getting your feedback on content, what you like, but I'm also working towards a big project in 2024, just trying to unpack some of the goals and some of the concerns that people have throughout their financial life, things like their financial regrets, mistakes, these types of things. Sarah's given me a 4 out of 10. Sarah, that's a tough one, but maybe I could see this joke was pretty polarizing. So anyway, there's a form there. It's in the chat. Say g'day to it. It would really help me out if you could do that. I use that research. It's anonymous. You can submit. It's almost cathartic there. You can submit your responses and away we go. So this month on Rask Live, we've got Drew with us today. At a couple of weeks, we will have Pete Wargent, property coach, economist, early, I guess, FIRE or financial independence blogger, one of Australia's biggest bloggers. He'll be joining us next week during the day. We've got Mike Kemp, the author of the Ulysses Contract. Many of you, especially Plant One, if you're watching in the chat now, this is probably the most requested guest, other than the doctor, of course, but Mike is probably the most requested guest in recent times, given his book has just been released. So that is happening next week. Speaking of books and free, cheap, good stuff, we've got the Ladies Finance Club has sold out in Sydney, but for anyone that is interested in coming to the Melbourne event in a few weeks, I'll put the link in the chat now. Ladies Finance Club tickets. You can get tickets for $35 or 10% off if you use the Rask coupon code. I'll be presenting at Ladies Finance Club in both Melbourne and Sydney. It's on the 7th of December at 6 p.m. It is an absolutely wonderful night when Molly puts on the Ladies Finance Club events around Australia. And I'm stoked that she has asked me to do a short 15-minute presentation on 3 big themes for investing in 2024. So come along. It's a wonderful evening. You hear from, there's legal experts, there's financial planners, there's, you name it, they're there. So get a hold of that. Okay, the other thing is the Major Street Publishing does have a current sale on. If you use the coupon code RASKXMAS, that's Rask with X, M-A-S, at checkout, you can get any of these books for 50% off. So any of these books for 50% off. We've got Mike on the show next week. Many of you know Evan. Many of you know Vince, Kate, my co-host, so many others here, Anna. Go and check it out. So this is the link in the chat now, and I'm going to put this books like that. It's in the chat now. You can get it with the coupon code RASKXMAS, 50% off. So why not? I bought a couple just the other day myself. I know about 20 of us went through last week and got got books. Great Christmas presents. More advanced as the Ulysses Contract. Kate's book is good all-rounder for any new parents or budding parents. Their kids ain't cheap. Mind Over Money is just an easy read from Evan. So there's so many different books here. Check it out. Danny's books I know get a lot of interest as well. So without further ado, let's switch gears. Let's cross over to Drew Meredith, who's joining us from the office in Melbourne. So Drew is one of the founders of Wattle Partners. He's an experienced financial and investment advisor. He's got many years of experience with SMSFs, portfolio construction, retirement, pension mode, accumulation mode. He writes prolifically, and he appears on the Australian Investors Podcast each and every week. I'm going to welcome him to the show right now. Drew Meredith, welcome.
Good to be here.
Yeah, mate. It's good to be live for a change, as opposed to in the studio, both of us just tucked away. So
Hopefully the rapport keeps up too.
Yes.
I noticed you've stolen my dad jokes and converted them to Rask Live.
That is. Yes. So Drew is the forefather of the dad jokes on financial airways. So I definitely did steal that from you, mate. And so
you're
if you
want rating up more highly than I am, so you should keep it.
So if you want to hear Drew's dad jokes, you can head over to the Australian Investors Podcast. Drew and I record and answer questions every Saturday morning at 7 a.m. don't worry, we're not recording at 7 a.m. That's just when the episode goes out. So we do tend to sleep in a little bit on weekends. We get up about 7:25.
Yeah.
So mate, we're going to be talking about, and I've got a few slides here. We're going to be talking about retirement, all of the common questions that folks have, and then we're going to roll into perhaps just answering some questions on the go. Now, before we get to this, it's really important, anyone who puts a question in the live chat or follows up with comments after the fact, we don't know your personal circumstances. So the best way to ask questions, particularly about retirement, which is a very important time of your financial life, is to just kind of keep it general, because that's all we can answer here. If you want to see a financial planner, they will be able to give you one-on-one advice or strategies that are, tailored to your goals, needs, and objectives. And of course, if we mention like managed funds, super funds, insurance, all of these wonderful things, please be sure to read the product disclosure statement and target market determination for those particular financial products before acting. And so first question here is this a real couple? This is just something that I pulled from Canva. I know you had the Waddle Partners retirement event, Drew.
I believe it's a real couple in the photo. I'm
I
not
reckon
making a real couple of
it-
actors in the photo.
It's real people. I don't think it's artificially created, but this is what a lot of people dream up when they think about retirement, right? This is the cliche, I guess.
Yeah, exactly. We just recorded a podcast with one of our clients. He's been with us for 22 years and kind of went through this journey. And honestly, it isn't. Like we were also at the event with John Glasser, who's a retirement coach, and he talks a lot about the fact that this isn't what retirement is. This is like a short period of your honeymoon period of retirement, which can last, a year or two at the beginning, and then it goes into all kinds of things, different levels of happiness and struggles, and then consolidation. And the client we're talking to today, he's basically retired 3 times. He retired at 28, he retired at 45, and then he retired again at 70, and took a significant period of time off at each period. So retirement's different for everyone, and as John Glass has said multiple times, it's not cocktails on a beach. You might enjoy that for a small period of time, but definitely not. It's more like the 3 Gs: gardening, grandkids, and golf. Even then, it's still not the whole thing.
Yeah, it's interesting that your client retired 3 times. I've actually only ever thought of retirement as a singular thing.
I think it was early on the FIRE movement. I
Right.
brought it up on the podcast too, that financial independence, retire early at 28. He went surfing for 7 years and changed career.
Wow. I know we're going to get to these questions, but one real quick thing do you think that may have happened because he wanted the purpose of investing? Does that make sense? So he wanted to get back and feel like he's doing something every day. Was that kind of what drove him back? Or
I think it was just finding a bigger world. I'm not sure. He also said you don't need to take 7 years off to find yourself, but having that kind of sabbatical or long service leave where you go and look at other cultures, where in this photo a lot of people wait until retirement to go and do that, whereas you become so much more worldly if you're able to do it well before at any level.
Yeah.
So that's kind of what he was saying, and kind of dealing with personal issues or whatever it was at the time, which helped set him up for an extended retirement and a happy one.
Yeah, fair enough. So a real quick and easy question. As I said, there's a link below the video for anyone watching. If you want to get in touch with a financial planner, you can do that quick and easy there. But if you were watching this at home, I was chatting to someone yesterday who was looking for a financial planner. Actually, 2 people that were looking for a financial planner yesterday, and one was able to retire, and one was probably 5 to 10 years out of retirement, a bit younger, still working. What are the types of things that you would be looking for in a financial advisor, and how would you find them?
I thought I was just going to answer call me, and that's fine, but not the time for that. I think what we found in financial advice, you see it as well, because I know we work with quite a few different financial advisors, is that financial advice is incredibly general. That I know at the Rask Live events, I've been asked for everything from mortgages to insurance to stock picking to portfolio construction, and a lot of advisors are kind of expected to have this general knowledge base, but it can be very difficult to add value and really help people significantly when you're such a generalist. So for each of these people, you want to find an advisor that is either specializing in what the period of your life at the moment, or what you're striving to attain. So for a lot of people, that's retirement advice, and we've doubled down and focused solely on retirement advice. But I know a lot of other groups have done similar things, and then also knowing the cohort. So you can imagine if I'm spending 2 days of my week trying to work out how to claim, TPD insurance cover, becomes difficult to keep up with superannuation changes in investment markets. And it's how do you add the most value and how do you support the most clients? So I think it's finding someone that firstly is experienced in what you're looking for. So for retirement, you want super and you probably want SMSFs. And then this person, as the client was today, 22 years with Jamie and us as an advice firm. So someone you can build rapport with and can continue to work with for a long period of time, not someone, and you can usually tell that pretty quickly. And you'll always say, go to the ASIC financial advice register, make sure they're actually advisors, because all the people in the papers aren't actually financial advisors or financial planners.
And that's probably I guess the kind of like ground rules is that you should always check that they actually are able to give you personal advice, and the way you can check that is through the Money Smart website, the ASIC website, so you can check their license and whatever. But beyond that, it's about building that relationship, because it is quite a vulnerable thing to expose all of your finances and oftentimes your relationship to a third party.
I think a good one there would also be to meet a few planners, because most upfront meetings or advisors, most upfront meetings won't cost anything. You don't necessarily need to get 3 statements of advice, but meeting a few advisors, finding out what they're good at, asking them the same questions, can definitely help in kind of narrowing down the one that suits best for you.
Mike, we're going to get to that's a good question in a little while, and CNA as well. We've got lots of good questions here already, which is fantastic. So maybe we'll try and speed through some of ours. We've got Drew for the hour, guys. So we'll get through to your questions. Wasn't going to ask this one, but just generally speaking, how much does it cost to see a financial planner? Because there's different, I know that can go from absolute minimum for simple to more complicated, like just general ballpark.
Yeah, so generally there's 2 types of advice for an advisor. There's upfront advice, which is, it's called a statement of advice. That's probably where a lot of the cost increases have gone because of not what happened during the Royal Commission, but a lot of compliance that came after that. So you're generally looking at a minimum about $5,000 for that statement of advice, anywhere up to $10,000. But that is something that lays out an entire financial strategy and modeling and recommendations and investments for what could be the next 20 or 30 years. So it's like a framework for the biggest decisions of your life. But it's generally 5 to 10 for that upfront advice. And then ongoing advice really depends on what's level of involvement and what level of advice you need, how regular that's going to be. Most of the industry charges a percentage. So that's usually 1% of assets under management. There's a growing group of firms. I think that's something that you've always liked or admired about us is a fixed fee basis. So I believe the normal ongoing, the average cost of ongoing advice is something like $6,000 to $7,000 per annum. And we've got a kind of a more of a niche, narrow cohort in retirement, which is about twice that.
Typically you deal with people that have slightly larger balances, I know, and like we're coming into retirement, maybe business owners, working professionals, that type of thing as well. But you can get in contact with the Waddle Partners team, again, using that link. But okay, so the question that a lot of people have, and I've got a little quick slide on this here. I don't have many slides, don't worry, folks. But one of the thing is that people know is they kind of know that they have an estimate or at least a figure in their mind of how much they probably want per year in retirement. And as you said, that kind of moves in cycles, like the honeymoon period of retirement. You're traveling, you're spending, maybe you want to support your kids a bit. And then you kind of go into a different phase of life. And then finally, a costly third stage of life, which is different in that it's not so much income, it's more assets. I guess just generally speaking here, what's normal for, say, a Waddle client versus say someone that's advised and versus, say, just general people that want to retire? Like, what is normal for someone that sees a financial advisor?
So I think this is the ASFA numbers, which says for a couple with a comfortable lifestyle, and I think there's lists of that, like how much you can travel if eating out a couple of nights a week, and that's $70,000. And the modelling suggests you need about $690,000 combined to fund that. What the challenge we see there is that would involve a level of Centrelink, and that's not necessarily predictable. You never know what's going to happen with means testing. I'm going to get habit out there on some of these comments today. I'm sure there'll be more follow-ups, but you never know how much that could change in the next 20 or 30 years. And it tends to basically assume that you're going to spend down to your last dollar the day that you die. So there's not and we're, as much as life expectancy figures are helpful, the experience is incredibly different. So most clients we see would generally have probably $1 million or so in superannuation each. So you're talking about this kind of $2 to $2.5 million portfolio of assets outside of their property.
Yep.
So that means they've probably been working in professional life for most of the super guarantee period since 1991 or 1992. And generally from professional backgrounds, a focus on investments and want kind of transparency and to know where their money's invested, but also want to know that the cash flow they're getting is sustainable, and that's something that only comes from that kind of regular feedback and I think just complete transparency of the underlying investments.
So I know a lot of folks. There's a lot of folks in the Selfwealth community, ASA community, but also Rask that do fit into that bracket because we've surveyed, and thanks to everyone that does submit this, so we actually can bring you better content. But we do know a lot of people do fit into that kind of 1 to 2 million plus. But there are options, a lot of options for advice for folks that say have got under that $1 million or a single or these types of things. So don't think that just because Drew throws these out that these are the required amounts for everyone, but that's indicative of his client base. And there are strategies for people. If you are listening to this and say you've got a couple $100 grand, 500 grand, as Drew mentioned, there are options. We do have the pension, and there are other alternatives that a good financial advisor can help you with, things like contribution, recontribution strategies. So there's actually a good question here. It's from Stuart, and it's related to kind of this cost of advice, accessing advice. Do you see a push by financial advisors to have their clients incorrectly classified as sophisticated investors so that they can provide less information? Now, I'll add the context here, is that in the law in Australia, there are effectively two classes of consumers, let's call it that. One is the people that meet a certain amount of income and a certain amount of assets, and they can be given different types of advice with less regulation. They're called sophisticated or wholesale investors. And then there are what we call retail, which is less, they don't meet that income or assets hurdle. So is that a way for folks for the advice profession to kind of drop the cost of advice, Drew? Does that happen?
It's a little bit of a loaded question. You know this. It's kind of like a topic that's pretty close to our heart as well. So in there, you said incorrectly classified.
Yeah.
And I think like technically they're probably correctly classified, because if the legislation says if you got over 2.5 million, you're sophisticated. In our view, you're not sophisticated just because you have more money. You need some level of financial knowledge and literacy. I think it was it Renato Motta? I was at one of the AFR event a few weeks back, and he said I think only 60% of people have good financial literacy. So like 40% would probably struggle to understand a share or a bond. But in terms of sophisticated, there's definitely like is bifurcation the right word, where
Probably.
there's big parts of I like big words if I don't know what they mean. If you listened on Saturdays, you'll get that too. There's big parts of the industry, so a lot of the investment banking part, basically, and they were also talking about at that event, where by classifying someone as a wholesale or a sophisticated client, you don't have to do the same level of disclosures. So in terms of fees, you don't have to do the same level of advice in terms of a statement of advice that we produce, 60 or 70 pages. And you don't have to do all the ongoing consent and opt-in requirements. So for instance, every year we have to re-agree on a fee an ongoing fee with our client. They have to opt into it, and they have to sign about 3 different forms to do that. So being outside and that's because we treat all of our clients as retail versus sophisticated. I don't think it's a push to necessarily reduce the cost of advice. I think it's just it's a business decision, because it's probably easier for them to grow by only servicing a single cohort. So in a similar way that we do retirement, they only take sophisticated investors.
Yeah.
Not saying it's a good thing or a bad thing, but yeah, it's very challenging. And definitely that that should be increased. There's or have some sort of test around it that says you need some financial education to be considered a sophisticated investor, because you essentially there's a whole range of fees that can be charged without full disclosure.
Yeah, that's the thing. It's sophisticated is actually a gateway, not just for you to access more
You lose
investment,
protections.
but you lose protections on the way. And so it actually puts more responsibility back on you. And that's the key thing there. I'm going to just jump to this question from Jim Greek, which said, good chat, gents. Is it possible to co-contribute into super from sold investment income? Jim, I'm not 100% sure, unless Drew knows what you're talking about. Can you maybe just reframe this question for us? Understand that the regular method is through the pathway of salary sacrifice from wage income up to 27.5K. I'm maybe going to reframe that if he doesn't do it for us, which is people that are thinking, how can I build my super balance like pre-retirement? What are the common ways you see that happening?
Yeah, so there's two types of, we know superannuation is the best entity structure by far, regardless of what's in the papers. Once you get to retirement, draw a pension, 0% tax rate, and that's why people love frank credits, because you get refunds on them.
Yeah.
Two main ways to increase it. So after-tax contributions, non-concessional, and pre-tax, which is what Jim the Greek, must be
Yep.
Jim the Greek, is
Yep.
referring to here. The limit on non-concessional is 27,500, and that can be made, and the question here is, that can be made via pre-tax income. So your super guarantee, which is now, I'm always going to get these wrong. Is it
11 or 11?
after that?
Yeah, it's something like that. Yeah.
Could be 12 already. And so your pre-tax, your concessional contribution includes your super guarantee. So you'd have to take that off the $27,500 limit, but you are allowed to make those contributions from after tax or from savings that you already have, and claim a tax deduction in your tax return rather than having a lower salary during the year, which can be valuable when you've got things. I assume he might be referring to capital gains. So
yeah,
that tax deduction can be used to reduce the taxable income for a given year as well. So that's definitely a strategy you can do, and something we look at quite regularly. So clients selling an investment property, how do you, and they're not working anymore, can you make a concessional contribution, get an extra 27,500 taken off the gain, and thus the tax bill as well?
Yeah. So then they could effectively, so I'm just going to play a scenario here, sell an investment property or even downgrade a primary residence, and potentially get that money across to super in two ways. One is up to the limit of 27.5, where they can claim a tax deduction. The other one would be a non-concessional contribution, where they kind of just make it out of their cash. They just pay money in or direct deposit money in. There's no tax deduction necessarily, but it just moves into super.
Yep, and I think the follow-up question was it just from investment earnings. So basically, these deductions go against your taxable income, whatever that taxable income is. So your total taxable income. Yep.
Okay. That's a good one. So I have another question that I want to ask you, which is more once you're in retirement, or even as you approach retirement. This is a question that I was dealing with last night, Drew, which is someone sitting there, they've maybe got either an SMSF, self-managed super, or they've got an industry fund or whatever, super fund they have. And they're thinking, it seems like it's not right, or I've got this money sitting outside of super in a brokerage account. It seems like I don't really have the structure. So I'm just generally speaking from a high level, what are the investment options that you would typically see in a portfolio, and how would you kind of put that together for them?
So you mean not across super products, but what we'd put into a...
Yeah, what would be in that portfolio? So maybe they've got super and then they've got a Selfwealth account, say with 500 grand, and I don't know, just making some numbers up. What is the composition of that, and what does it look like?
Yeah, I mean, we've got the gold rules, which I won't go through all of them here. A couple of them, we don't have enough time for that. One of them is income plus growth equals total return. So an issue we see is that a lot of investors that are trying to do it themselves, or even advisors, focus only on the income side. So the first thing, and one of the issues, my business partner Jamie was quoted, I think it was in the Australian this week, that said basically the ASX has gone nowhere for 16 years. So you've had zero growth and only income from it. And I think that's one of the reasons that we'll always ensure that you're investing into income and growth oriented assets in the super fund, in even more relevant with inflation and cost of living increasing at the moment. The other one is that we're agnostic to product. So without getting religious, we'll hold direct stocks for people who feel they're comfortable and they've got the right risk profile for it, we'll hold index funds and active funds because we think both have a role to play, and we'll use exchange traded funds and active managed funds, or what they call unlisted managed funds, as well. So it's finding the blend that's suitable for each person, and naturally having our own preference. So we generally have an ETF or a low cost core with a series of actively managed strategies around it, or for those keen on the kind of or experienced in investing, then it would have direct stocks in Australia, and then ETFs and funds around the outside of that as well. But some clients, we just do all ETFs.
Yeah.
Which
So
matching
some
that
clients,
risk profile.
yeah. So it's basically like you do the risk profile with them. You have like an allocation to risk on and risk off assets, or like stocks and bonds, cash, property, blah blah blah, and then that informs a top-down view. And you might also look at if they've got existing ETFs or shares, and that kind of how that fits in the puzzle, and then build around that. Okay, great. So there was
the question there is also, what do you value? So we have this conversation with clients as well. If cost is all that they're worried about, then it might be that you build an incredibly low cost portfolio, which you can do from like BlackRock and Vanguard for under 10 or 20 basis, so 0.1, 0.2%. But with that comes, we talk about all the time, is a higher level of volatility. So are you willing to weigh up lower fees for high volatility, or do you want a smoother ride throughout retirement? And then we'll dial up either the risk or the level of active management depending on the client's sensitivity to fees, and how much transparency they want.
There was a question that just come through from Richard, and you took the words right out of my mouth, Richard, because it's something we do talk a bit about every week on the podcast. So Richard did ask a question: is there a general rule for the amount of money that should be in super versus out of super as you approach retirement?
Generally, you want as much as you can into super. So I'd say for most people, it's like 100%
Right.
outside of your house. When you're starting to get towards the caps that we talk about, so the $3 million per person caps, that's when you would start thinking about having assets in your own name or a family trust. And then the broader rule would be 2/3 in super, 1/3 outside super.
Yeah.
And when you're in full retirement, you can have assets of about $500,000 each if you're in a couple, in your own name without paying any real income tax on it. So that's probably where that comes from. Average retirement, 3 million, 2 in super, 1 out.
Yeah. I'd probably just say for any of the accumulators, so slightly younger folks that maybe want early retirement, or it's still 20 years away until you hit that preservation age for super, is you want to be building wealth outside of super as well, because you can't access super until you can access it. So you need to build wealth outside of super to build that passive income earlier. And then you always have the option, if you're 45 and you've got a few $100,000 outside of super, we've always got the option that you could contribute it if you want to keep working, or you could trickle it in, or these types of things. But basically, the longer the time between you and retirement, the more legislative risk, the more goalposts might shift. Yes, you get more compounding, but it's just weighing that balance up. My other question was, so this is one of the AI questions that come through. I asked Google Bard to help me out, and then I asked it the same questions that it gave me, and the answers were horrible. The question, one of the popular things on people's mind is inflation was like 5.4% at the moment here in Australia. And indeed, I'm dealing with this question a lot. People are saying, well, I've got my SMSF, or, I've got some money in cash. It's not really earning that much. And inflation's 5.4%. Is that a risk? Is my future being eaten away by inflation, even though I don't really realize it? Like, am I asleep at the wheel? So how do you kind of protect a retiree or a pre-retiree's portfolio and passive income from inflation?
I'm still in transitory camp here. You've seen US inflation fall to 3.2%. There's always going to be some level of inflation. And then the portfolios we build, and using our team at Atchison as well, is testing on how you generate a return so for retirement and Australian super be the same, CPI plus 3 to 4%. So you're kind of baking it into your objective by having that CPI part there.
Mm-hmm.
But we've seen that if you rely solely on income, you're never going to get the growth that you want, because generally you're investing into companies that pay out all their profits as dividends, and then the companies you talk about all the time, so WiseTech, Xero, and Pro Medicus, they're companies that are reinvesting in themselves and doing it for growth. So the only way to kind of offset the impact of inflation is to grow at least a portion of your capital. So even in balanced portfolios, you're still going to have at least 50% in growth assets. And you want to make sure that is always exposed to the the strongest long-term themes over 10, 20, 30 years rather than focusing on the short term. But I think it's so much, we see it all the time that we treat something like Telstra as a bond essentially, and we hold it for the income, but the share price hasn't moved even if I have a good call on it occasionally, it hasn't moved really. It's still well below its I think its original listing price is $6.80 because it just pays out 90% in cash flow. So invest for growth, look overseas. One, I think, is that I think it's Warren Buffett, I always say, is wrong. And this, if you don't understand investment, don't own it. I think it's more like educate yourself on investments. So I've seen too many people that won't buy a bond, won't buy a corporate bond, won't buy US shares because the perception that they have through whatever it happens to be thinks it's too risky, but I think it's riskier not to have those things in your portfolio.
Absolutely. Rodney did make a great comment and this is kind of relating to what we were just saying, Rodney. Thanks for contributing, mate. You said now with the contribution limits, you can't necessarily get money into super as easily, and so have to deal with the assets outside of it, which absolutely. And there's the 27,500 ceiling on concessional, but then there's also non-concessional limits as well. So how much you can just go straight out of your own pocket, and the basic idea here, Drew, if I'm not mistaken, is that if you go over those limits, there's consequences, and those consequences are normally in the form of excessive tax rates.
It's been cleaned up a bit more recently. That it used to be as much as I think like 70 to 80% tax on earnings of excess contributions, but now basically you just refund that. But the limit's now 110,000 per person per year, and I've written about a bit that most people don't really start that sort of contributions until their 50s. You spend your 40s kind of stagnating and going nowhere because you're paying school fees, mortgages, and then it accelerates a lot. And one big change, so the contribution limits have been hit harder, but where more broadly you can now contribute until you're 75. So the work test has essentially been removed for everyone up to 75. So you've got a longer period to do that, which probably reflects that people are living longer at the same time.
Yeah. There was a comment here from MRT, which you're going to have to correct me live, Drew, if this is the case. MRT says, what age can you access super from a super fund versus an SMSF? And I'm pretty sure it's exactly the same, but I could be wrong.
Yeah, all the same. There's three types of super fund: industry fund, retail or super platform, and then a SMSF. They're all subject to the same rules of preservation. So generally it's 60 if you're for a part condition of release, and 65 for a full condition of release.
Yep. Okay. San, just jumping down a bit, they said, what's the best way to generate income for retirement and also safeguard this from future partners of our children? Okay, so this is actually more an estate planning question, San. You got two in one here. Just generating income. You said before that even for someone with a balanced investment profile, they probably have quite a bit exposure. This is to Vigis's question as well. They would have quite a bit of exposure to growth assets, knowing that they've still got, if you're 65, your life expectancy is probably 85 or 90, right? So you've still got a long window that you need to compound your money. You can't just take all income. But so what you would have Aussie shares, you would have US shares, ETFs, managed funds. Would there be anything else on that side of it that preserves long-term growth?
Yeah, so we look at alternative assets in there as well. So things like credit, which is probably in the news a lot at the moment. So I know Metrics is quite popular, probably with all the audiences. And that's just only one example of a lot, which is it's basically a bond, and hybrids they're probably more in the defensive side than in the growth side. So lending money to companies is what we're talking about there, which is what a term deposit or a bond is. Infrastructure assets. Commercial property that you can buy in different ways. So, we like this Charter Hall Long Whale REIT that's listed on the ASX. It's yielding something like 8%. So for us, it's all about building resilient income and growth streams from multiple revenue or cash flow sources. So have some commercial property, maybe have some healthcare property, some agricultural property, however you can access it. alongside your bank and mining heavy ASX listed shares, because we know that's always going to be the case. So how do you offset those and make sure if the banks cut dividends like they did in the pandemic, you're still getting plenty of income from the other parts of your portfolio?
Yeah. So my final question that I had for you here, and we'll come back to the chat. Don't worry, in a
Lots of
second,
engagement
folks.
here too, isn't there? Yep.
Yeah, it's
Hard to
great.
keep up.
Just if you do ask a question, folks, please remember that just keep your questions generalized. We have to be very careful. We take our responsibilities very seriously. We do want you to keep your questions generalized. Don't give us your age, your super balance, your credit card information. Like, do not put that stuff online here in the chat, because that's what you need to see a financial planner for. And I will, just before I cross to my screen here, Drew,
Yes.
Mania Memberful, I think it is. I'm just sorry if I pronounced that wrong. May I ask Drew if he was referring to CHC on the ASX, or if when he was referring to Charter Hall? I think you're referring to CLW.
CLW. Don't look at the share price. It's been.
Yeah.
Oh, sorry.
Yeah, there it is. Anyway.
So when we're looking at these income sources, we like Charter Hall is a solid company, but it's also a funds management company, as well as owning and operating these assets. So the Long Whale REIT is a real estate investment trust. It owns the property, and the income you get is from the rental payments, not from anything else, essentially.
Yeah. So
That's kind of.
So, and Rodney did just clarify that. So this is a real estate investment trust. So this owns the property. There's another company on the ASX called Charter Hall. That's the actual company that runs all the investing. So Drew is talking about the REIT, not the company, just to be very clear. And it's obviously part of a very diverse portfolio. Obviously, anyone that knows commercial property and interest rates and property markets over the past few years will know it's not like the solution for a time. It's one part of a very diversified portfolio. Okay, so speaking of warnings for people, common mistakes that you see retirees or pre-retirees make, even people that are younger that are like trying to just get passive income. What are some of the mistakes? We did an episode of the podcast, 10 mistakes, or I think you came with 6 maybe a couple of months ago on the Australian Investors podcast, but generally a couple of mistakes that people make and how they can avoid them.
I tried to do a story about this live on stage. Didn't turn out very well. Like getting the sugar hit. It was something to do with aging fine wine or something like that. And apparently it fell pretty flat. So
it didn't
help me out of that one. I think, but the reference there, and I'll keep working on that one for the next event, is that we tend to think too short term. And that's reflected in multiple ways. So retiring at 60, 65, I think you said it before, you could be 25, 30, 35 years of retirement. So how do you avoid making decisions about what's happening today or tomorrow and guide that with a much bigger framework? You see examples like we have clients that joined us recently, but during the pandemic, they came in and asked for advice. They wanted to sell or switch their growth fund to a defensive fund because they were worried that they would lose all their capital in the sell-off. That was the fastest sell-off we'd seen in history. Our advice was naturally don't change anything. You're investing for 30 years. But that the thought that short-term impact and seeing their balance move was forcing them into making a bad decision or an emotional decision. So I think when you've got a long-term framework, you can see through things like the pandemic, inflation, interest rate hikes, and stay to the course essentially, and don't make those mistakes. Don't sell. The biggest mistake is obviously selling at the bottom and capitalizing losses at that point. And then the one that kind of keeps me up at night most of the time is maybe not keeps me up. 2 kids is pretty tiring. So uncompensated risk in portfolios. So I've been talking about this a bit more recently, which is there's risk that you're compensated for, as in every time you buy a share, you want an expectation of return and you want to understand what the downside is if it goes to zero. But I think the way portfolios are built and without a solid framework, we tend to end up thinking we're diversified when we're not. That could be holding 4 banks, 2 resource companies, and a few other things, and think, oh, I'm diversified, I got 40, but you're still exposed to very similar drivers. And then again, that kind of extends into, I think only 8% of there was a survey recently, 8% of people understood how a bond worked. So not being invested into lower risk investments like bonds and fixed income, particularly now interest rates, and you can, the government will pay you 5% on a 30-year government bond now. So not, taking more risk than you need to, and then having these kind of uncompensated risks within your portfolio that are kind of setting you up for not for failure, but for more volatility and uncertainty than you need.
It's like this kind of like magical balance, isn't it? Like where someone asks you, well, what can I expect from a balanced portfolio over the long term? And you're like, well, I don't know, somewhere between, you don't know, but on average over 10 years, maybe it's somewhere between 6 and 10%, maybe less,
Exactly.
maybe more. But then if you take too much risk and you put too many stocks in and not enough cash and bonds and that sort of stuff, well, people think, well, I'll just get more return. Well, not necessarily. Your return might actually go down because you're taking unnecessary risk. It's a balancing act. It's actually like to amp up the returns of a portfolio often means considerably more risk. And some people might get lucky, but a lot of people might not.
Bonds were in a perfect example of that over the last 3 years, not this year aside, but so many people were in a conservative product that thought there was lower risk than growth. But when interest rates started increasing for that 2-year period, bond values went down significantly, and a lot of conservative options underperformed higher risk options when it should have been the opposite. So that's another uncompensated risk in portfolios, which was that duration story.
Stuart's asked a question about bonds, which I'll quickly nip in the bud. But Drew has been banging on to me, guys, about doing another summer series. So a couple of years ago on Selfwealth Live, Drew, Jamie, and we did a retirement series, a dedicated retirement series for the first 4 weeks of January. And he was messaging me the other day saying, hey, can we do it again? Can we do it again? I was like, Drew, I want to be fishing during January. Come on, mate.
I don't.
But yeah, you want to be talking about retirement, obviously.
We can do it from the beach if you want.
But if you do want Drew to come back in January and do a full retirement session, can you just give us a thumbs up in the chat or something like this to say, yes, please, yes, please. Please let us know. Just put it in the chat right now to say thumbs up.
It was like deep dive on stocks to buy, funds you might use,
retirement planning,
investments,
superannuation, estate planning. Stuart's question was, why aren't bonds very popular amongst Australian investors? I can quickly tell you some of the reasons why, Stuart. It's because bonds in academic theory for finance are very popular because a lot of the theory is based on US markets and US research. And over there, they don't have franking credits and these types of incentives, like a lot of the kind of negative gearing type stuff that we have here in Australia. So naturally, Australians have different options versus US investors. We also have offset accounts and these types of things, which are very tax effective for younger people. Now, all that said, as you approach retirement, they should be at least as popular as they are in the US because there are benefits to them. And there are other things to keep in mind, other differences, but that's one of the big things. Sam did ask a question before. I think it was Sam. And I'm just going to recap on this because I know it's super popular and it's something we can touch on in January if you twist my arm enough, Drew.
Have you seen all these comments? There you go.
Yeah, well, there you go. Yeah, so everyone's getting involved. Thanks, and just shooting down my plans to go fishing.
We could do it on the boat. That'd be interesting.
Well, to be honest, Drew, I was going to buy a boat today, and it actually sold on me yesterday. So there you go. Anyway, that's my personal life. Never mind my tragedies. There was a question before, I think it was from San, who said something along the lines of estate planning, and there was another one about death taxes in the chat. You would deal with this a lot, and I imagine a lot of people don't deal with this until they see a financial planner, but they don't deal with it properly, which is if you've got this nest egg, people get sick, people die, things happen, right? How do you protect, just generally from a high level, what are the steps people can take to protect their wealth, maybe even their family's wealth, make sure it goes to the right place? Like, what are the types of conversations you have and where do you push people?
I mean, the most important one is having a will in place, and we tend to forget it, and then, and even when we have one, we don't necessarily keep updating it when circumstances change. So having a valid will in place is key. On your superannuation, you can basically, it's called a binding nomination, so you can bind the trustee to pay your superannuation to certain people. Another option there is to make sure your super's paid to your estate and then treated according to the wishes in your estate. generally the most, not that anything's perfect, but the strategy used by most people is to have a testamentary trust within their estate. So when they pass, their children have the option to inherit, or their beneficiaries have the option to inherit their share of the assets in a trust structure that has tax benefits, which you probably don't need to go through on here. But being a trust, the beneficiary doesn't necessarily own it directly. They just have entitlements over the income. And it can provide some level of protection by having the beneficiaries limited to that beneficiary plus their children and spouse and partners, or whatever it happens to be. So that's one of the main ways, but I think nothing is completely protected from that. I think it's so important, estate planning, to focus, and investing. There's a tendency to go cheap and get a DIY will, but that's what estate lawyers love, is DIY wills, because they're quite easy to challenge. So investing properly in a proper will, and going through this process, which we do for our clients all the time, and then work with solicitors to make sure they express the wishes and have these kind of considerations.
I was actually at the Australia Post last week. I was picking up a bunch of books that I bought over here. And in front of me, the lady was like, "Can I grab the DIY will kit?" And the Australia Post person was trying to help them through that process. And I was just thinking to myself, it costs money, but it doesn't cost a lot of money to see a lawyer to help you get that drawn up. I guess something's better than nothing. But can I just confirm kind of what you said? I'm going to get my Mr. Squiggle out here for those of you that remember that. So you effectively have the super, and it nominates the estate.
Yes.
And then within
so your
that,
superannuation isn't an estate asset. So your superannuation is paid according to the decision of the trustee. So for it to get to your estate, you have to make a nomination to send it there.
Okay, so you make a binding nom. That's what I'm going to put here. This is.
How do you write so well with a mouse?
I've been doing the Rask and Selfwealth Live for about 2.5 years now. So I'm at about a grade 2 level.
Credit.
But so then thank you, sir. So this goes. So you do a binding nomination or a nomination. You lodge that with your super fund, the trustee. It's set up so that it would not always, but in some instances, in your client's case, it goes to the estate, and then it goes from the estate on death into a testamentary trust. Is that right?
Yeah, so it can either be paid directly to beneficiaries, or it can fall into a testamentary trust. And testamentary meaning, I believe, like a last will and testament is upon death.
All right, there's my little squiggle.
That's my Latin lesson for the day.
Okay.
And then you can nominate who the beneficiaries are. You can have a trust per beneficiary. You can put restrictions on those trusts. They're only able to access the income or the capital at 21, 35, all these different restrictions that you might use.
So that's all set up in there.
Yeah.
In the trust. Okay. Yeah. Cool. Okay. Cool. I just wanted to cover that off because obviously that structure, I'd imagine, can also help with potentially if you've got like kids that are in your relationships, or you want to protect them from something happening with their money or your money, even blah 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 blah. I'd imagine. Yeah. Okay. Cool. So that's great. So we're kind of on the edge of the time here now. Basically, everyone has said yes. Which is fantastic. So thank you, everyone. You can use the comment functionality on YouTube after the fact. So if you're not watching live, you're watching this back, say you're in Perth and it's still morning for you, you can just leave us a comment on YouTube. We do read those and we can put it together. So there was a couple of questions before. Rodney said fishing is overrated. I would strongly disagree with you, Rodney. It is a wonderful way to clear your mind and find investment ideas. But anyway, so there was a question before about bonds not being great when interest rates were high, were going up, and that's fair. So there was another question earlier on about this from Dominic. I think the reason why bonds had an absolutely tragic 2022 is because interest rates were at historic lows and they went up. And as interest rates go up, the value of existing bonds goes down. But as the interest rates go up, they start yielding more, which means in the future, folks get more income, basically. Yeah. And if interest rates fall, then what happens is the value of your bonds go up. So that is the kind of dynamic that was at play. And that's why so many conservative investors got hurt in the last 2 years. Whereas now arguably it's the opposite of that, right, Drew?
Yeah, this is kind of the story I was going with before, which is you can get low cost, which is Vanguard is an example, but they're balanced and high growth products were were holding long duration government bonds for the last 3 years as interest rates went up. So they've struggled significantly because there were losses in bonds during that rising interest rate period. But you have to put the last 2 years into context, that you've had essentially since the 1980s falling interest rates the entire period, and now you've seen a small from something like 13 down to 0, and now you've seen a small kick up from 0 back to 5. So everything, and we're very good in investments to extrapolate the short term into the long term. So we were assuming that a lot of people were assuming interest rate would just stay low forever, which meant bonds would provide no income. You'd never be subject to losses. But now that they're at 5%, there's growing consensus as inflation falls that rates are likely to hold where they are, potentially be cut next year, depending on what happens to the economy, in which case they become attractive and potentially offer capital gains. We caught up with, do you remember Craig Ferguson from Noosa yesterday? Yeah. And he's bullish on duration, heavily bullish on duration. Just for that fact, because rates will fall if there's a recession or not. Rates are falling, and you're getting paid 5% to lend money to the government at the moment, and the government won't default.
Yes.
Put that on record.
Put that on record. So for those that don't know, we have a running joke on the Australian Investors podcast. His name's Dr. Andrew Dermott. And the reason we bring this up is every Saturday morning at 7 a.m., Drew does give us a market update. We talk about companies and we answer questions. So if you like this chat, between now and say January, if we do this live thing, which it seems like I have to now, so thanks everyone. It would seem that you can go there to the Australian Investors podcast and listen to Drew and I talk about these things. But I do also understand that Drew has a direct line to one of Australia's and the world's leading academics in economics. And Bill Mitchell will be appearing on the Australian Investors podcast in hopefully a few weeks. So if you are listening to that, you will get to hear one of the sharpest minds in the world on this type of topic. Maybe we'll finish with one other question, which was from Rodney about bonds. Sorry, we made the whole thing about bonds, but is there a way to hold bonds directly in Australia rather than just through a managed fund or ETF? I think there is.
There's a few groups that will fractionalize bonds, but I think it's almost like a broking house as well. But I think it's so cheap to be able to access. It depends. What your thesis is. If you just want access to the income and the correlation benefit, then there's nothing better than just buying the benchmark at the moment. Buying your IAF or your VBND and these kind of global and domestic long-term government bonds. I think generally the minimum investment is $500,000 for an individual bond, then it's difficult to trade and the trading costs go up. So I almost don't stray too far out, and then you're making individual decisions on bonds as well as equities. So it's keep it simple is the way I usually go for it. But there are some trading houses that will fractionalize bonds.
Yeah. I think there's some of them available via the exchange. I think they're called XTBs, but I don't think for Rodney and anyone watching that wants to get into individual bonds like individual stocks, it's, to be honest, from my research, there seems to be very little value in that versus just picking the big rocks. I think there's more value to be had in picking individual companies, which is also risky. We know that. But I think there's more value to be had in that, because oftentimes what you're doing in bonds is you're fighting over basis points. Like you're competing for very small parcel size, very small, arbitrages in value and that type of stuff. Getting a bit geeky, but never mind. So if you are watching the video, you will, if you go into the video and below here, you will see a link to financial planning. You can visit the Waddle Partners website. We did clearly get a lot of votes for this January session, where we can answer questions like Michael says, are fixed coupon bonds getting more attractive, or would you stay with floating rate notes? You could do both, Michael. Just saying, generally speaking, a lot of investors try and make false choices. We talk about this a lot every week. You can do both. When I say you, I mean everyone generally. Drew is available on the Waddle Partners website and through that link. He's also on Twitter. Very nascent days for him on Twitter, but he is there. He does exist. Mate, this has been heaps of fun. Clearly, folks want us to do it again, so we will. And I appreciate you taking the time out to join me, mate.
Thanks. Good to see you.
Always. Pleasure. All right, there goes Drew Meredith from Waddle Partners Financial Planning, based in Melbourne, but does service clients all across the country. Before you go, we do have a few things. Don't forget, we're back next week, and Drew and I will start putting the touches on a session for January. So we know you love it. Whether you're in the Selfwealth or ASA or Rask community, we will do that for you if that's what you want. We do actually respond to when you give us feedback, because a lot of people just listen to our podcast or just watch our videos or just send us an email. But if you actually give us feedback, we will incorporate that and make what we do better for you. So if you do find all of what we do useful, please take a moment to fill this in, and we will use this for a new series next year. We will do estate planning. I can see that in one of the sessions in January. We might even be able to get a lawyer on as well. I can see so many people saying this was wonderful. So you've convinced me that I have to at least step off the boat for a little while in January and step away from the salty shores. So there's that. Down here, I will final thing is this is my quote for the week, and I shared this the other day. It's from the Rule Breakers, Rule Makers finance book. If you love investing in individual companies, it is a wonderful, wonderful book. And I got the original hardcover one, which is this one right here. I got this delivered to me. It's a great read. It's written in 1999, but you know that an investing book is a good one when it tells you things that are still relevant nearly 25 years later. And so the thing that I've got for you this week in terms of my quote is a lesson to all investors. Business is as simple as changing the rules at the beginning and then making the rules at the end. And that is a wonderful quote on what it takes to start a business, to do something new and innovative and push the world forward, and what it takes when your business matures and how you can capture value for your shareholders. So that's from the Rule Breakers, Rule Makers book by the Gardner brothers. We'll be back next week with Mike Kemp. Arguably, to be honest, I'd probably say he's the most well-read investor I have ever met. And he's a wonderful author, thinker on retirement. So he'll be back next week. Please, please, please join us next Wednesday. It is at midday as well for Mike during the day. So come back then. We've got Pete Wargent the following week. And then we'll have, I think we've got even more before Christmas. So heaps to come on Rask Live, whether you're on Selfwealth, ASA, Twitter, wherever you are, pardon me. Don't forget to hit subscribe. Thank you, everyone, today who commented. Get in touch with financial planners. If you're approaching retirement, it's one of the 2 best times in your life to get financial planning advice. Do it, and we will see you soon. And good luck. I think it was Megan, you said before, dealing with the estate planning fiascos that come with blended families. Good luck to you, and good luck to everyone. Bye for now. I'll see you when I'm looking at you, which is probably next week. See you then.